We're looking at absolute liquid ratio. Now, it's not a popular ratio because the examiner in his 21 edition so far has not tested this ratio. But then, case study is full of surprises, has a lot of new things the examiner introduced to take care of balance. So it's good you are aware of the ratio. It resonates or works more in industries like investment companies, banks, and other financial institutions, fintechs. They calculate these ratios more. But it doesn't work mostly because if you look at the items that are absolutely liquid, not applicable to some industries like manufacturing, healthcare, FMCG, pharmaceuticals, practically. So it's not a popular ratio, I must admit, but then it's good you have a knowledge of it so that anywhere you see it under exam condition, you will know that you've seen this before. Okay, so it's called cash position ratio. You could call it cash position ratio or overdue liability ratio. So those are the synonyms for absolute liquid ratio. It establishes the relationship between the absolute liquid assets and current liabilities. It's a stringent liquidity ratio or liquidity metric that evaluates a company's ability to meet its short-term liabilities with its most liquid assets, specifically cash and cash equivalent plus marketable securities. So where the company invests in marketable securities like short-term deposits, commercial papers, etc. Now those are liquid assets that can easily be turned to cash. The ratio is a clear picture of the entity's immediate liquidity position by focusing solely on assets that can easily be sold and converted to cash. So that's what it looks at. The components include cash in hand at bank, marketable securities, temporary investments, short-term deposits, and is calculated as the absolute liquid assets divided by the current liabilities, or cash and cash equivalent, which is a liquid asset, most liquid asset, and marketable securities that looks at all those other investment components we talked about. Okay, so in interpreting this ratio, the larger these ratios, the better the ability for the company to meet its short-term obligations. However, the company must strike a balance between holding large working capital and having inadequate working capital. So where you have too much cash tied down in working capital relative to what is needed to meet day-to-day operations, the company will be losing money for holding idle cash. So it's good to invest in cash and cash equivalent marketable securities that will yield returns in the short run, and they will generate income. And that's the essence of having most of those commercial papers, short-term deposits, and it helps enhance your liquidity position with interests. If the company does not hold enough working capital, we know what is the challenges of meeting creditors, short-term creditors, and petitioning to wind down the company. Yeah, creditors could write to close down the company because you've not paid them their money. So the company needs to strike a balance between your current and your current liquid assets, which means that your most liquid assets are available to meet exigencies. So generally a ratio of 1, just like we saw in cash, is or suggests that you can safely rely on liquid assets, excluding inventory and receivables, to meet this obligation. So let's look at Kabir again to calculate these ratios. So excluding trade receivables, inventory, we have our cash and cash equivalent, we have marketable securities, treasury bills, certificate of deposits, money market funds, commercial papers, and foreign currency deposits. So wise companies, instead of tying down their current assets maybe in cash, so they can invest in these that have returns in the short run. Most of these short-term liquid assets are invested and they yield returns for the company in the short run, 3 months, 6 months, 1 year. Very good investments. So let's look at them as we calculate our absolute liquid ratio. So I'll pick these items.
Yes, question again. So, yes. So now we are considering cash and cash equivalents and anything, any marketable security.
Exactly. Right? So just like you see
any
on the screen. Let me go back to the
security.
formula. Exactly. Okay, so you can see the formula on the screen. It's either cash and cash equivalent plus marketable securities. So that's it.
Okay.
Yes. Okay, so take note of that. So for Dan Kabir, we have this cash and cash equivalent. So let me pick all their components and pick the figures only. Okay, so I'll go to our calculator and I have it as this. So let me take this and put it in 2020. Exactly. Okay, so I have the total for the absolute liquid assets. So I have the total as 225,750,000. So let me go click my current liabilities for 2020, and I have it as 420. So our absolute liquid ratio is the liquid assets divided by current liabilities, and I have it as half, 0.54 is to 1.00. That's what I have. Okay, so ACAs, let me have 2021 quickly. I know Julie must have fastly calculated that. So I have half, that's 54% of the absolute liquid asset is the makeup of the current liabilities. So can I have 2021 and 2022, please?
I have 0.56 and 0.57.
Okay, 0.56, 0.57. Thank you. 0.57. 0.57. Okay, fantastic. Any other person? Salmat, is your network allowing you on the call? Are you on the call?
So I am here, but I can't even see your screen. I'm just listening in. Excuse me for today.
Oh, okay, sorry. I guess network din is not allowing you to see the screen.
Yes, I'll just listen.
Sorry about that. All right. Okay, Aisha, what do you have? Julie has given us 0.56, 0.57. Aisha, are you there? Aisha is, you are muted if you are speaking. I hope she has not dozed off. Okay. All right, let's run because of time. So let me pick for 2020, 2022. Let me validate Julie's.
I was trying to calculate.
Oh, okay. You are still calculating. All right, it's fine. So we just wait for a minute.
I don't know. I have 0.29 for
0.29. Okay.
Is that right? Then I have 0. I don't think this is right. No.
There's no harm trying. We're all learning. So you don't have to be right here, but you have to be right on the exam day.
Yeah, sure.
Yeah. So 0.29. So what do you have? You said?
Can you validate it, sir? Here.
Okay, I should go back to the question.
No, I have the question. I'm looking at the question. Don't worry.
Oh, okay.
What am I picking wrong?
Okay, so let me go back to the formula so that you can see it. So look at the formula on the screen: cash and cash equivalent plus marketable securities divided by your current liabilities.
I'm adding the treasury bills, certificates of deposits, right?
Exactly. Those are marketable securities too.
Yes.
Yes, so you're adding all of them.
$59.
Are we adding the commercial paper, foreign currency deposit, money market funds?
Exactly. They are all marketable securities. So everything down from cash and cash equivalent, it was not stated the type of marketable securities, but they are worth about 21 million in the year 2020. So treasury bills were specified, certificate deposits, money market funds, commercial papers. So you're adding all of them because they're absolutely liquid. You can change them within 3-6 months to cash.
Oh, okay.
So you're adding all of them.
Subtract. We can take the total current asset and subtract inventory and trade receivable.
Exactly. That's another way to work it. Exactly.
That is the fastest way of doing it.
Oh, that's the fastest.
Since they're all together.
Yeah.
Yes.
I didn't think of that.
I like that. Under exam condition, you can just pass that shortcut to save time.
Okay. For 2020, the last one, 2022, is 0.57.
That's 5657, correct? Same thing Julie had, approximately 57. So are you still sticking with 0.29?
No, I can
2021?
work that, but let me know which the term. I've gotten the concept now.
All right, fantastic. So let me just drag and see if Julie, yes. So Julie aligns very, very correctly. So 0.54, it increased to 0.56, 0.57, but it's still less than 1. Because if you look at the threshold here, the general threshold says if you have a ratio of 1 or more, suggests that the company can fully meet its short-term obligations without relying on inventory or trade debtors, which is receivables. So we are still less than 1, even though it's half, but then still less than 1. Even though it's a pharmaceutical company. Yes. You said?
For 2021, what was it? I have 5.6. Is that correct?
5.4, 2021.
Okay, I got 5.6. Okay.
Okay.
It's
2021, yes. Yes, 2021 is 5.6 exactly. I thought you said 2020.
Okay.
Yeah,
Yes,
I got
correct.
0.56 now for
good,
2021.
Good. Oh, fantastic. So we are all on the same page. Okay, so more importantly, let's move to the implication.
Yeah.
So looking at the ratio, 1 suggests that the company can fully meet, but Tankabir is less than 1. It means looking at a higher absolute above 1 implies strong liquidity, demonstrating the company can or has ample cash or marketable securities to pay off its current debt without touching inventory and receivables. While a lower one raises concern about the company's ability to address short-term obligations promptly. So we're looking at quickly, because receivables may not be gotten quickly from debtors, while inventory may not be converted from inventory to cash in the near future, depending on the stock. But these marketable securities, if they are not up to 1, may raise concerns about meeting current needs very, very quickly. So what are the causes of a high absolute liquidity ratio where you have above 1? Substantial holdings in cash and marketable securities, effective cash management strategies, or a conservative approach to financing. So these are the causes of a high ALR, while the effects include enhanced financial stability, increased investor confidence, improved ability to respond to unexpected financial challenges without touching or looking at inventory or receivables. While a low one is the opposite, shows limited cash or marketable securities, and is good for chartered accountants to understand their needs and be able to invest maybe excess cash into marketable securities that can yield you interests. Very important. And you can just post that as other income that increases your performance in your SCI. So inefficiencies in cash flow management also could cause this, and the effects include increased risk of liquidity problems, profitability difficulties in meeting short-term debts, and adverse effects on credit rating. So I'll say something here very briefly. The essence of investing in marketable securities is to get more income. And when you get more income, you can convert it to cash. Those interests you get from those securities, you can convert it to cash and move them back to your cash and cash equivalent. So it's another way of raising short-term capital. So in conclusion, the ALR is a vital measure of a company's liquidity, depending on the industry anyway, highlighting its capacity to meet short-term liabilities with its only most liquid assets. So in my office, for example, practically we hardly do all these marketable securities. So we send it to the parent company and they invest it for us to get more interest. So where you outsource this activity and maybe pay a fee for that, it must be managed judiciously and wisely by experts. Monitoring this ratio by chartered accountants helps stakeholders gauge the company's financial resilience and the readiness to handle immediate obligations without depending on less liquid assets. So this is very important. So the resilience means if you need money quickly within a week, a month, the ability to change those securities, sell them off, and pay off your debt shows your readiness to handle these challenges with precision. It's very important. All right, so that's the ALR, very unpopular, but then in case you see it, you have an idea of what it looks like. Any question? Let's run. Okay, so I believe we understand it graphically with its interpretation. Okay, so let's move to inventory holding period. Now, this is an activity ratio. Let me confess here, it's an activity ratio. Why did I bring it into liquidity? Is because I don't want to mix it up in the activity ratio when we get there. So we have the days and we have the times. So this is inventory holding period that measures the amount of days, just days. But how many times is the reverse, which is activity? Though some textbooks use both of them as activity, but I prefer to bring it here liquidity because it separates both of them. Even though it doesn't measure ratio, it measures the amount of days we could recoup either inventory or receivables or pay our payables. So don't get confused if you see it in maybe exams that inventory holding period is an activity ratio. I brought it here liquidity to separate it from how many times it is. So just take note of that. I use that I just call that, I use that as a disclaimer. Let me call that a disclaimer. So take note. But it's not out of place anyway. Inventory holding period is also among working capital management ratios. So it's not out of place to put it as liquidity. So, but if you see it as activity, I'll say, Josiah taught us something wrong. Go, no, I'm not wrong, and I'm not also absolutely wrong. All right. So this IHP, inventory holding period, is a key efficiency metric that measures the average time it takes for a company to sell off its inventory. So typically or generally it's looked at that, okay, if you have inventory, you should sell them off in 30 days. But depending on the nature of the stock or the inventory, it shows how long it could go out of your store from the day it's purchased or is turned to finished goods for sale. It indicates how well a business manages its inventory levels and turnover, providing insights into operational efficiency and cash flow management. So this is the formula. Your average inventory, looking at your beginning and your ending. Take note of that. The first of the month, when you started producing or started production, to the end of the month and you divide it by 2. So you look at your cost of goods sold and how many days you are able to turn over that inventory in days, not how many times. Very simple. What does it mean? It means that it represents the number of days on average that inventory is held before it's sold. So how many do you stock and how long was the time lag to sell it off? A shorter holding period indicates faster inventory turnover, which is generally favorable for maintaining liquidity and minimizing holding cost. Exactly. So the shorter, the better. The longer, then you are tying down your working capital. Okay, so before we look at the implication, let's quickly go and use the same Dan Kabir to calculate this ratio. All right. So we have the beginning of our inventory, which is 315, and we have the ending, which is 378. So let's go. And that's the essence of the beginning and the ending. So we have these two. No. So not 2021. Okay, so let me say the beginning. Inventory and the ending. So let me say beginning. And the ending. All right, so we have this as our beginning and ending. Don't forget. Then we have our average inventory. Okay, let me pick that. So we have the total, and we'll divide it by 2 so that it will be easily understood. So we have the total, which is this. And we have the average inventory, which will be this divided by 2 to have an average. Don't forget, so under exam condition, where do you don't have the beginning and ending for 2020, you just pick that figure under exam condition. But for 2021, don't forget you're going to calculate 2020 plus 2021 divided by 2. When you are doing 2022, you do 2021, 2022 divided by 2. Don't forget that. All right, so we have the average as 346,500. So what does the formula state? Cost of goods sold or cost of sales. So let's go to the SCI and we pick the cost of sales. So we're not picking opening, we're not picking.
So we're not picking the. Okay, that's what I wanted to ask.
Exactly. So we're not picking opening, we're not picking purchases, we are picking the total cost of sales. And with cost of sales, we have 1.1 billion.
Oh no, the question I have is, sorry, is the opening inventory and the closing inventory. Why
exactly
the ones on the income statement?
Very good question. Fantastic question. So looking at a manufacturing setting now, your opening inventory is what you started the year with. Then you purchased materials to produce. So you are not selling. You have a total, then you closed that period, manufacturing period, with this amount. Now, when you do your opening purchases and total, then you have a closing, you naturally have a cost of sales. So it's a cycle within a year. So these are raw materials in the company that you use for production. But when you come to your balance sheet, you are telling us that at the end of the year stock count, this is what your inventory is valued at, 315 million of 2020 January. So at the end of 31st December 2019, this is your value. Remember, we do stock count where auditors come and count stock. So this is the value, and this is the actual recognition of your inventory in your financial statement. Then this is at the end of 31st December 2020. This is how it has moved. So what's the difference between 315 and 378? It means that okay, sorry. Julie, you're saying something? Oh, okay. I thought you were trying to interject.
No.
Okay. Oh, okay. So 315 and it moved to 375 means within that year you must have produced. You must have produced more inventory that increased the value. Yes, please, I can hear you. Sorry, interjected. You're trying to say something. Okay, let me continue. Maybe it's an interference. Okay, so what we are saying is this is a production cycle and this is the actual inventory value. So you are not using your production cycle in your manufacturing account or your SCI. You are using your balance sheet value because this is the actual value of what you have in your inventory as finished goods. This is very important. I hope that is clear, Aisha.
Yes, it is.
Now, please, I am lost. But me, I didn't get the same figure as you. I was going to ask what's going on as I cannot see the screen. So you're saying the figure, the negative 275 in our income statement, we should add it to the closing of 2020. Oh, what's going on?
No.
Okay, so Aisha, will you go ahead? Let me hear your thoughts on this.
Oh, okay. Sorry, I didn't know it was unmuted.
Oh, okay, so, yeah. You wanted to speak to Salma's Rufi's question.
Okay. We're not picking the one on the statement of the profit and loss because it is the circle for the year. What is used in production for the year. But the one, the closing one on the statement of financial position is what is actually used and left, right, sir? Am I?
Exactly.
Okay, exactly. So Aisha, what was your sorry, your question was why are we not using the one in the profit or loss account?
Yes.
Oh, okay. It's usually the statement of financial position. Okay. But I still added it. I did not get the 208 because I did 315 plus 378, and I did not get the same thing. With what?
Okay, you didn't get the same.
I got 346. Is that the figure?
500. Yes, 346 500. That's the figure for the average.
Yes. Okay.
Yes. So we're on the same page. All right, Julie, do you have any thoughts? Do you have any comments on this? Are you okay?
It's okay, sir.
Okay, fantastic. So let's go pick our cost of sales since we all align with the same position. So let's go to our cost of sales and we have 1.1 billion at the end of the year as our cost of bringing the service to the. Okay, so let me remove the negativity so that I can have the absolute. All right, so our inventory holding. So our inventory holding period will be our average inventory divided by our cost of sales times 365 days. Simple. So if you look at the formula on the screen, average inventory cost of sales times 365 days. And that's exactly what we did here. So we have it as 115 days on average. So that's almost 3 months or 4 months. Yeah, 30 days, 30 times 4 is 120. So let's say 4 months, less than 5 days is what it takes to convert our inventory to cash on average for the year 2020. Okay, so we are looking at the inventory holding period, and don't forget it's in days, 115 days. It's not a ratio, it's in days, and that's why it's an activity. Most textbooks put it in activity column. But then I prefer it here in liquidity so that I can differentiate it from how many times. So the reverse of this formula, will be looking at it in the activity ratio, where you have cost of sales as your numerator and average inventory as your denominator. So we'll be looking at that in activity when we move to the next ratio. Okay, so I need you guys to give me 2021, 2022, how many days? I know Julie has the figure.
119.7. That's 120 days, right? Is as 119.7, does it mean it's 120 days or 119 days?
No, 119.7 is yes, 120 days. I agree with you because approximately 119.7, that 0.7 is above 5. So that should give us 120 days. So I agree with 130 days.
Then 117.
Please, is it
17 points. That's 127.
Sorry, let me catch Julie's thoughts first. I'll come back to you. Julie, please come again.
1. The next is 117 points. So that's 117.
Yes, 117. I agree. It's not up to 5. So 117 days. Okay. Salmat or Aisha, you're speaking.
Yes. So I was trying to, maybe everyone should solve first before I can ask my question so I don't distract. I was trying to figure out for the inventory for 2021. So you said it is the closing of 2020 and that of 2021. That's 378 plus 415,800.
Exactly.
Is that correct?
Exactly. Very correct. And that's what I presume Julie did. Exactly.
Divide by 2, then we now divide it by the cost of sales.
Yes, exactly. So let me just pick the figures so that we can be fast, not waste time.
I got 0.32.
You got
0.32.
is 0.32.
Multiply by 365. It will give you 117.
Yes, multiply by 365. Don't forget the formula. This you are doing how many days? Say it.
I have 119.72.
Okay, for which year?
That's for 2021.
2021.
Okay, 2021. 119.72 exactly. So 120 days, exactly as Julie got. So can approximate 119.7 to 120 days. Good. So what of for 2022?
117 days.
Fantastic. 117 days. All right, Rufi, do you disagree? Let's give you time to calculate then. Let me also be picking my figures so that I can validate it.
Okay.
Okay, I finished picking my figures, so we're waiting for you to give us your figures. How many days? So looking at the average, we're looking at 4 months for it to talk. Yeah, please go ahead. Please go ahead.
For 2022, I 117.24.
Okay, 117.24 exactly. So it's 117. So we all align. It's the same thing. 120, 17. Okay, so that's all of us. So let me just drag and see. Exactly. So we all have the same figures. Very good. Okay. So above that, let's see what it means. Now, the implication is that a lower inventory holding period. Oh, sorry, Rufi. She's coming back. Network is pushing her out. Okay. Okay, a lower inventory holding period implies efficient inventory management. So on a general level, if you look at generally, we're looking at 30 days, but it depends on the industry and the products, talking about the products in hand. So The general 30 days benchmark may not be applicable to some industries, but then the lower and shorter the holding period from 30 days, maybe 45, 60 days, the better for the cycle. Now, it implies inventory holding period implies efficient inventory management and quicker sales, leading to improved cash flow. While a higher one, like this case now we are seeing 4 months on average, period may indicate overstocking, slow sales to convert your revenue to cash, or inefficiencies in the supply chain, moving from your store to distributors, wholesalers to retailers to final consumers before they get money back. The supply chain can be very disruptive, which can tie up capital and increase storage costs, where you have to stock up your materials in the store for long before you get your money back. It can be detrimental to your working capital management. So what are the costs and effects of a short inventory holding period? So where you have a shorter 60 days, 45, 30 days, which is mostly recommended, shows efficient inventory management practices, strong demand for the goods or the products, because some of them fast-moving consumer goods, or efficient sales and marketing strategy. So marketing is really working to push out the goods immediately they come in, and you find in most cases you have shorter inventory holding period. While the effects include improved cash flow, reduced storage cost, and lower risk of inventory obsolescence. So you have a lot of cash that's converted within the shortest period, and the storage of those stock, the cost of it, especially if it's not on site, it's off site, will reduce. And inventory expiration, that's what we call obsolescence, expiration, and issues with deterioration in inventory, especially if they are edible items, is reduced drastically, and that's the effect. And a long IHP can be caused by overproduction, too much, or underplanning. You produce so much, you didn't forecast well, the company didn't forecast well, or declining sales. Inventory is tied up, marketing is not pushing it out, ineffective marketing, poor inventory management practices can be the causes. While the effects is increased holding costs. So where you have a store in the market, you have to be paying for security, lighting, you pay for storage space and all that. So increased holding cost, potential write-downs where they've expired, you write it off based on IAS 2. States you should write off inventory that expired at the lower of cost and net realizable value. So you are making some losses. For obsolete inventory, you have also cash issues that can hinder operation, because this is part of your working capital. Don't forget. So the effects of a long holding period is not nice on day-to-day management of working capital. So in conclusion, the IHP is very crucial for a company, especially where it deals with stock practically, and the efficiency and overall operational effectiveness. So chartered accountants, we need to monitor this ratio to help enhance cash flow levels and improve profitability while minimizing the risk associated with excess inventory. This is very important. All right, so do we have any questions? We have 3 more. We have receivables, trade payables, and net working capital to sales ratio. I don't think we can cover the 3 this night. Maybe we just do 1 because it's already 10 minutes to 10. Okay, so do we have questions for this IHP? Okay, no questions. So let's run to receivables collection period. Quickly, I think this should be our last. In 10 minutes, we should be able to clear this one. All right. This ratio is also known as days sales outstanding. It measures the average number of days it takes for a company to collect payments from customers after sale has been made on credit. So it doesn't apply to cash sales, don't forget, because you've already collected cash, immediately you sold out, cash and carry. But this is on credit, take note. This ratio is crucial for assessing a company's efficiency in managing its account receivables and cash flow. Formally, they call it trade payables, but IFRS came to call it, refurbished the name to call it receivables. All right. So we have the formulas: average account receivables, that's the beginning and the ending, divided by the credit. Take note, where you don't have credit in the question, you can just take the revenue figure, but it's mostly measured on the credit sales that you didn't collect money immediately, to see the average time it takes you to collect the money in number of days. It means or indicates how quickly a company converts its account receivables into cash. A shorter collection period suggests the company is efficient in collecting payments. Typically 30 days is the general benchmark, while a longer period may indicate issues with credit policies or customer payment behavior. So in my office, normally we look at 60 days. So after 30 days, we've invoiced you. In 30 days, you should be able to pay back. Depending on the industry, like healthcare, a company look at 60 days, but some faster companies like FMCG, they consider 30 days as the benchmark. So take note of that. All right. So let me quickly rush to calculating this ratio now. And let's see how graphically applies. So then, Kabir, let me go. How much do they have in receivables? So trade receivables for the beginning is 420, and for the ending is 493. So within the year, they increased giving out of that facility. All right, so we have it as beginning. Let me just put B. B, you know what it means, which is beginning.
Excuse me, can you show us the formula, please? The formula, okay. I didn't say formula.
All right, let me go back. I know you'll be able to help us calculate quickly. Let me go back to the formula. Okay, so that's the formula. We have the average account receivables. That's beginning and ending divided by total credit sales.
Okay, average. Okay, that's opening plus closing.
Exactly. Exactly. Yes. Yes.
Right.
Yes.
Divided by total credit sales. Yes, question: what's the difference between credit sales and account receivables?
Okay, so account receivables and credit sales are different. Now, account receivables are they are the same. It's the same. So the amount you give out as credit is your receivable, so it's the same.
Why didn't they put total credit?
Account receivable has everything. It has both cash and credit. I don't know if you understand. But for credit, it's like you give somebody more, they are not paying cash immediately. Because there's always that cash where you have cash, then the other one is not cash. I said there are situations like that where the transaction they'll say cash sales and there is credit sales.
That's what I'm saying. Credit sales are account receivables now. So what is the difference?
Yeah,
there must be a difference because they didn't say total account receivables at the denominator. They put total credit sales. So there must be a difference.
Good. So let me explain the difference, and as I'm calculating it, I will explain the difference. I like Julie's question. It's a very vital question, and take note of that question. So based on the formula, I've already taken the beginning trade receivables, which is 420 million, and the ending trade receivables, which is 493,500. So take note of it. So trade receivables, and with her question at the back of our mind. So let's go back to the revenue figure. Don't forget, we are picking the sales revenue. So how do we determine the credit? Because this sales revenue encompasses both cash and credit. So in most financials or most of the questions, there's always a note. And if there is no note, you take all the revenue as your denominator. Don't forget your formula states credit sales. But if you don't have credit stated, take the whole revenue. Now I'll tell you the difference between credit sales and account receivable from this question. So if you look at the sales revenue for 31st December, the first one we are taking is 1.3 billion, 1,320 million based on this question. Now, go through the notes. There's a note. If you look at this note here, it states the second one, okay, the third one, of the yearly revenue, total revenue yearly, 85% was cash. Take note. Sales.
Okay.
While the balance was credit sales. So take note of it. There's always a caveat. But where there's no caveat on this, just take the whole revenue. Okay, so coming back to your question, what's the difference between accounts receivable and sales? You'll see the accounts receivable and credit sales. You'll see the difference now. It's practical. So let me go now and take the sales revenue. This is the sales revenue. Now let's take credit. So sales revenue is assumed to be cash and credit. Both is 1.320. So our credit will now be 85%. So we'll say this divided by 0.15. Take note. 85% is cash. Credit is 15%. So let me change it here to 15%. Because if you go back to the caveat, you'll see that. Let's go there and see. Of the total revenue, 85% is cash. So what is the balance? It's 15%. So 15% is credit. So we are taking 15% of the credit, which is 8.8 million. Take note of that. Very tricky under exam condition. Okay, so we've not gotten our average. You don't forget the average trade receivables. So the average will now be trade receivables will now be this total divided by 2. So our average is 456,750 and our credit sales is 8.8 billion naira. Is it 8.8 billion? No. It can't be 8.8 billion. We have 1.3 billion. How come it's okay? 880. Something is wrong. Something is wrong with that. Yes, what's 15% of 1.3 billion?
Okay, I think you are putting. Okay, you're not putting the 00. Okay. And 50%, 1.5 times 1320.
How come I'm having 88? Well, on my calculator, I'm having 198.
198,000.
Yes. So this is what I'm supposed to have. Exactly. I just punched my calculator and I have one there. So I have 198 million. So what's the total cash sales? It will now be this minus credit. So our cash sales, exactly. Our cash sales is 1,122 million. Okay. So now, Julie asked a question. What's the difference between trade receivables and credit sales? So as at a particular period in 2020, we had it as 198 million. Now that particular period is the ending of 2020. You can see that they've offsetted the bill. But now in the beginning, the bill was 420 million. At the ending, it was 493. So we picked the average. So as at the end, estimation of your credit sales is 198 million. So what's the difference? The difference between trade receivables is the amount given out, and the credit sales is the actual that is remaining as at the end of that year. So you see that there is a difference, 198 and 493. But at the beginning, it was 420. So the movement between the receivables is the difference between what you gave out as credit and what is actually remain as the value of the credit at the end of the year. I know it may be a bit tricky, but
looking at the relation now. Okay, it means trade receivables appears in the statement of financial position. That means it's the balance.
Exactly.
Then the credit sales is the actual credit sales for that year.
Yeah, thank you.
The actual credit sales. Okay.
Yes, exactly. Okay. Exactly.
So that's why it's balanced. Okay, I understand it now. But it is the same thing, but it's just the period, the position that is being considered.
Exactly. Yeah. Exactly. So let's consider this as cash sales of 85%. So did you understand Julie's question? It's a fantastic question to understand what the terms mean. So Rufi and Aisha, do you guys get it?
It's tricky.
Yes, very tricky, very tricky, but it's good. But it's good. You'll be able to understand what those terms mean in practical terms. It's not just cramming the ratio. It's easy to cram now, but there are some questions you get that are off exam. These ones are maybe off exam questions, and you should be able to interpret it based on the variables in the financials. So let me hear your thoughts now, Aisha, Rufi, Salmat is on the call. Let's hear your thoughts on this. It's a fantastic deliberation or conversation. So what do you guys think? I think Julie understands it and I understand it. So let me get your explanation if you also understand the difference between trade receivables and credit sales. Are they there? Is Aisha there?
Are they sleeping?
I hope you guys have not slept up. They are there. Aisha and Salma.
Oh, I am here.
Okay, you guys are silent. It shows that you understand the difference between credit sales and accounts receivable.
Yes, that's what I was trying to share my thought on earlier. Like what I understand by the credit sales are like the sales that were not received through cash, like it wasn't cash that was paid.
Exactly. That's correct. And what of credit sales? What are your thoughts on credit sales?
So that's what I just explained.
Okay, so you are saying that the same thing in your assessment is just that the movements within the year and the balances based on the figures is what differentiates them, right?
No, I mean that the trade she was saying trade receivable. I said the trade receivable is like the mother of everything. That's like the total of whether
yes,
it's a credit or a sales.
Yes, the base, exactly.
That's like the total of all of it.
Yeah, exactly. Okay, however way we understand it, we are correct, but it's in the interpretation now that will now make us distinct. Yes, it will make us distinct. So we have not calculated the ratio. We've been deliberating on the meanings, which is good. So let's calculate the ratio now by 65 days. So we have our average accounts receivables. We have our average account receivable, which is 456,750. And we also have our credit sales, which is 15%. So our average no. Our receivables collection period or days sales outstanding is our average trade receivables divided by our credit sales times 365. But how comes? Are you sure I did the right thing? Let me do it again.
I'm getting something close. I'm getting something close too for 2021. So
that's
which rather I would like to be surprised too.
This is 840. This is 842 days. That's ridiculous. Is that what you got?
Yes.
Wow.
I got 868.3.
Hey, that's 868 days. What of 2022?
Maybe it's the kind of business they do. I don't know the kind of business they do.
Yes, let's look at Dan Kabir. Let's look at the industry. Because if the industry moves their inventory, the dynamic operating within the pharmaceutical industry, Kano. 800, the good will have expired now. It will have expired. How many months is that?
Is it cars they are selling? What are they selling?
I'm telling you, you didn't hear the industry. It said pharmaceutical. Pharmaceutical industry in Kano. I hope they are not contraband goods that will have expired.
I don't know. And the 2022 is 850. 850.
850 days. That's ridiculous. So let's calculate it. That's how many months? We have 365 days. 365 days in a year. That's how many years then? Times 4.
Maybe it's I don't understand. Maybe we got something wrong.
I'm not sure because 15% of their credit is 198 million. Yeah, so it's the credit we use. So we are correct. We didn't get anything wrong. And we took the average divided by the credit. That means the company is horrible. So 365 days times 2 is 730 days. So it takes 2 years. No. This is horrible. It's a horrible result.
It's not correct. There's something wrong somewhere, I think.
No, our computation is correct. The interpretation is horrible. That means their credit sales is a bad state. Very, very bad. Even though the percentage is low, if you look at the credit, it's just 15%. At least they were able to get 1.2 billion in cash. But then this 198 million is also material. It's material. You can't just write it off because with these days now and their pharmaceutical products, they will have expired. So you just write them off. Or do we have another way you look at it? Do you have drugs that last 5 years expiry, 4 years, 3 years? Yes, I think so.
Or maybe it's like a bad debt written off. Maybe it's a bad debt account receivables.
Well, looking at the time frame, it may be, but look at it from this angle. Like our products, I worked in Orange Drugs group that sells Sodrex, Bosca. Some of our goods, if they produce them this year, 2025, they expire in 2030, 5 years, some 4 years.
Okay.
So it's possible that their receivable period, they elongate it maybe because they feel the goods will not expire on them. Yeah.
Will not expire. Okay. Maybe.
Yes. So if you look at these 750 days now, if you do 365 times 2, that's 2 years. So 730 minus 7842 minus 730 is 101 days. So let's say.
So are you getting 730 from?
Okay, so I did 365 times 2. That's 2 years. 365 days in a year now.
Okay, yes. Okay, 730 minus 842. That's 112.
Yeah, so 112 days plus a year. So let's say a year and 112 days. That should be, let's say 4 months.
2 divided by 365. Okay. Times 12. 3 months, 4 months, yeah. 4 months, exactly.
4 months, exactly. So let's say 2 years, 4 months to collect their receivables. So if the goods have not expired and they have maybe 5 years expired, 4 years, I think it's in order.
Okay. Yeah.
Yes, I think it's for pharmaceuticals. So because I worked there for 3 years, I worked in Orange Drugs for three years. So some of those goods when they come. Yes, please.
So can you define these receivable days again? What's the definition so you can register properly with this with these figures we are getting?
Okay, fantastic. So the receivable days measures the average number of days it takes for the company to collect payment from its customers after a sale has been made.
Okay. That's why they have most of them in cash. It's 5% in cash.
Exactly. So if you have 85% in cash, I mean, you've covered a substantial amount. Yes, 50% is credit.
2 years.
Yes. So if you say 15% is more than 2 years, it's not bad, even though the amount is material. But in our view, it's still okay.
Maybe those are the very expensive drugs.
And maybe they also have long dates, long expiry.
Yes. Yeah.
So you may consider that. So these factors are very good to bring into there. I like this conversation. And Aisha and Rufi, Salmat, I hope you guys are understanding where we are looking at, considering the results. Fantastic. Okay. So did you get the same values Julie had so that we may not be able to, go back calculating it?
I can't really see your screen, so I'm just following.
But you know the question is in the group. This Dan Kabir is in the group.
Yeah, I have the question. I've been solving others. This one, I got lost one time, so I just said, let me listen. I've been solving the rest.
I agree, because the answer is quite scary. When I first tried this, I said, come on, man, in the right path, because it was scary.
Exactly. Even me too. When I did 842 days, I thought it's Excel. I manipulated Excel by mistake. But when you had the same thing, I said no. So maybe I should just validate the figures quickly so that we can be sure that we're on the right page. Then when we release the videos now, Salmat and Aisha can quickly calculate it. All right. So let me pick for 2021 and 2022 and see. So our trade receivables, we have 54. The only issue is that you have to calculate the average. So that will waste our time. So this is for closing 2021. Then this will be for opening 2021. Okay, so let's get the average now. So for this will be for closing 2022. Then the closing for 2021 will now be the opening for 2022. Okay. All right. So we have 583. So let's go pick our revenue figure for both years, 1.4 and 1.6 billion. Come have it here. Okay. So let me use calculator because I don't understand what Excel was giving me. 1452 times 0.15. I have it as 217,800. And 1669.8 times 0.15. I have it as 250,470. Okay. So let's get our cash sales. All right. So 85% is substantial. So let's do this. Julie, you are very correct, though. Very correct. Yeah, very correct. Exactly. 868,850. So that may be the interpretation. All right, let's run. We've taken 30 minutes more. So let's interpret this and close. So what does it mean? It means that it indicates how quickly a company converts its account receivables into cash. How quickly. So aside cash sales, the credit, how much are you able to recoup your money back? Julie made a statement. She said, or is it bad? It can go bad if you don't do that. You become bad debt, bad receivables. So the shorter collection period suggests that the company is effective in collecting payments from customers, while a longer one indicates issues with credit policies or customer payment behavior. And this is the implication. A lower receivable collection period, the time, looking at how many days, reflects strong cash flow management and effective collection policies. Conversely, a higher period may signal potential cash flow problems and inefficiencies in collection process. So like we were deliberating and having the conversation, if you have 50% of that amount of revenue tied down, then there's problem. But looking at the meager amount of 15% still makes sense, but 198 million is still material. Currently, IFRS 9 says you should provide for expected credit losses. Formerly, we used to have it as a provision for bad debt. But in the current IFRS, you have to provide for expected credit loss with that percentage. And it can adversely affect the company's financial stability. So what is the cause and effect? You have a short receivables. It shows good credit management, prompt invoicing, strong customer relationship, effective collection policy strategies in line with policy. And the effect is improve cash flow, improve working capital, enhance liquidity, reduce risks of bad debt. Yeah, Julie mentioned this. While a longer one shows maybe lenient credit policies. That may be the case of Dan Kabir, looking at maybe the drugs are 5 years, so they were lenient on credit policies, and it culminated in slow customer payment practices and also ineffective collection efforts. This may be the causes. While the effects if it's material, can cause cash flow constraints. It may lead to bad debt, potential negative impact on operational funding because you need it for your day-to-day running of your business. So in conclusion, it's a vital metric for assessing a company's effectiveness in managing accounts receivables, and cash flow. So we need to monitor this ratio as businesses to identify areas for improvement and their collection processes, optimize cash flow, and enhance overall financial health. This is very, very important. All right. So we've taken about 15 minutes added, but I think it's worthwhile that we look at that.
Yes, sir.
All right. So, yeah. So do we have any questions so that can shut down? We'll continue
the submission time of the case study you gave us, you said it's Thursday.
Exactly. Thursday, 12 a.m. Thursday to Friday night.
Okay, so it's between Thursday and Friday.
Yes, 12 a.m. is the timeline because on Friday we may look at the Friday case study. Okay, no, Friday is audit. Okay, so we can look at the solution. Yeah, so audit is Friday. So we may look at the solution on Monday with case study time. We can just look at the solution. I know it's very pepperish. You guys saw the unseen, very pepperish, Abby.
I would like to use, I've not opened it.
I honestly just complete question I saw this morning. I did not even know that you had sent. I was waiting like, I have not sent the unseen. It was this morning I saw the computer. I was like, oh, you sent the unseen.
Yeah,
I tend to look at it tomorrow.
Yeah,
okay.
I did not really read it. I just checked them. I just checked to see if it's direct. I said direct. If it's internal or external, I'm like, oh, okay.
Okay, so you guys have like 4 days. Is it 4 days? Yes, tomorrow, Tuesday, Wednesday,
and you
Thursday.
said we will answer 2 requirements.
You said?
You said we must answer the 2 requirements.
Of course, you have slim chances of passing according to your examiner if you don't answer the 2 requirements. So
yes,
it's a must. It's a must. It's a very pepperish question, and I like it. It's almost the same thing with the last diet. That's why I chose it.
Yes, that I noticed that
when you noticed the SWOT. You noticed the SWOT, right?
And I'm like, why does it look like my last diet question?
Exactly. And that's why I picked it first before we now do last diet. It has similarities, even the requirement too. If you are solving it, you'll see it. It's a very pepperish question, very pepperish. But then I believe you guys will chew it, you'll crunch it.
Okay. We hope so.
Yes.
Hope so.